Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So today I'm back with another video and today's topic is mastering the stop loss. So this is a really important topic in trading that you need to understand the stop loss, right? This is like your insurance while trading, right? So understanding the stop loss is really important, and today in this video I'm going to simplify it, how you can place your stop loss, where you can place your stop loss. So let's get started with the video. And just before that, a small disclaimer. I am not a SEBI registered analyst and this video is only for educational purpose. Any stock discussed in this video is not a recommendation, and please consult your financial advisor before taking any trade or making any investment. So let's get started with the today's video. So the first question that comes to mind, that is simply, what is a stop loss, right? So stop loss is like insurance. It's like a cushion to protect you when something goes wrong. So trading is a probabilistic game where the chances of winning and losing are always 50-50, right? So that is the basic crux. Although it can be increased or decreased depending upon your skill level and luck as well. But overall, trading is a game of 50-50%, right? So the work that stop loss does is that it protects you from the risk of ruin, right? So it protects you from completely ruining your capital, like completely losing your capital, right? So let's try to understand it with an example, right? So this was a stock that I also posted in my last video, that the setup itself was really good. First we had a gap up here and the stock was in a good uptrend and was taking supported 20-day 21-day moving average. Plus there was a nice base formation that was happening here, and that too within the range of this bigger candle, right? So it was coming out of this range, so that was the entry point. That is the basic and typical entry point, right? So there are only two possibilities here. After this, after you have taken an entry, there are only two possibilities, that the stock will go up or the stock will go down, right? So in case the stock goes up, you'll earn profits, and if the stock goes down, you'll make losses, right? So what happened in this case? So you see, the stock opened up, but there were earnings, and due to earnings were below expectations of the street, so it went down, right? So after that, the stock went down. So what would have happened in this case? You would have made losses, right? But here comes the role of the stop loss. Stop loss is a point where it's just a point where you'll book the loss. That is the simple definition if I give the definition of stop loss, right? So you have decided a point where you'll be taking the loss, no matter how much the loss is, but you have predefined a certain point where you'll be taking the loss, right? So otherwise, what would have happened? You would have bought somewhere the stock somewhere around 620 or maybe 615 or so, let's say, and the stock fell down to 470 in just 2 days, right? So just imagine the loss that would have been there in that case. But stop loss protects you. So stop loss could be at this point or maybe at this point where you'll be booking the loss, that okay, the let's suppose any random point, let's say 580, right? So let's say that the price has broken 580 and you'll be taking the loss here. You'll be booking the loss, whatever loss you had, instead of just holding the stock, right? So many beginners still make this mistake, that they don't place the stop loss, right? So that is another one of the big mistake of making losses in the market, that you don't place your stop loss. Because again, how long will you be holding this stock, waiting for the stock to come at back at your price where you will be booking the position, right? So you'll be waiting, if this stock comes back to 615, I'll book the position, right? So that would be the point of no profit and no loss. So that is the basic beginner mistake that everybody makes. Like even I made this simple mistake in the beginning, right? So that's why we have something called a stop loss. That is simply a point where you have decided that I'll be taking the loss, right? So there are multiple ways to place your stop loss, right? So these are the three most common ways, that is the fixed percentage basis, trend following stop loss, and the subjective stop. So this is subjective stop. I've just given a name. This is just my method, the method I use for placing the stop loss. Because again, it's not easy to figure out where exactly you should put your stop loss, right? Because again, you don't know how, because sometimes what happens is that you have taken a position, the stock comes down and again starts going up, and you have missed that stock because you can't keep your stop loss very close as well, and you can't even keep it at a very far point where you will be making multiple losses, because again at the end you have to protect your capital as well, right? So in the market you are here for making returns, but at the same time you have to do that while protecting your capital, because again market is always trying to take away your capital, right? So there are three methods that we can use to place the stop loss, right? So the first one is the fixed percentage stop loss. So in this case it's simple that you have already decided a fixed percentage of stop loss, right? So fixed percent just simply means that like you have decided, let's say you are only going to take a 5% loss. Okay, so that is kind of a fixed percent stop loss, and you take all the trade based on that. Like Sir William O'Neill used a max 8% stop loss. So he said you need to book your position at any cost if the stock goes down 8% from your buy price. So that is basically what a fixed percentage stop loss is. So like this is a small portion from his book. So remember, 7 to 8% is your absolute loss limit. You must sell without hesitation, no waiting a days to see what might happen, no hoping that the stock will rally back, no need to wait for the day's market close. Nothing but the fact that you're down 7 or 8% below your cost should have a bearing on the situation at this point, right? So it's not like he always used 8%, but that was his max limit, right? He won't be taking any loss on any position more than 8%. So that way you can also decide a certain percentage, fixed percentage point in your case. Like if I tell, in my case I have a fixed percentage of 6%, like I won't take any loss more than 6%. I'll cut my position as soon as the stock drops 6% from my entry price, right? So that is the limit for me, right? It could be anything else for you. Like some people like to operate with only a 2 or 3% stop loss. No matter what kind of entry they are taking, they'll just keep the stop loss fixed at 2 and 3%, 2 or 3%. Again, that also makes sense because here you are decreasing your risk of ruin. Because again, even like let's say you took 10 positions, right? So you took 10 positions and all 10 of them hit your stop loss. So 2% on every position, right? So let's keep the position size standard and everything. Let's just take it as a simple example, right? So the most you're losing is like 20% of your capital in 10 trades. Like I'm keeping everything is in simple, right? So I'm not adjusting the positions. I'm not just adjusting anything. Just take a simple example, right? So that is how you can reduce your risk. Now just imagine the similar case with somebody taking a 5% stop loss, right? So on 5% stop loss, if he makes 20 wrong trades, he'll be losing his entire capital, right? So I'm just keeping it basic, right? So I'm not uh, doing a risk percentage on the basis of position size, a risk percentage on the basis of portfolio and all of that, right? So I'm just taking a simple example to give you a simple understanding, right? So that is what a fixed stop loss percentage, fixed percentage stop loss is. That you define a simple percentage of your stop loss. That could be the percentage of your position size, and it could be the percentage of your portfolio as well, right? So what is the difference between these two? There's a very simple difference is that, so let's say you typically take a trade with a 20% stop, right? You take a trade with a 20% stop, sorry, 20% position size, my bad, 20% position size. Here you will be keeping a stop loss of let's say uh, 5% or so, right? So again, and on the portfolio, or you can take a trade on the portfolio basis, like okay, my position size is 20% and my overall risk is only just 1% of my entire portfolio, right? So that depends on you. You keep the loss stop loss percentage as percent, as per your position size or as per your portfolio. That totally depends on you, right? So second method is trend following stop loss. So this is more like a trailing stop loss. Like here you try to capture the entire trend with your with keeping your stop loss, with shifting your stop loss with time as the price moves, right? So trend following stop loss is used in cases where you want to capture the longer moves. Here you will make use of moving averages to trail your stop loss, like the 10-day moving average or a 20-day moving average, or a 50-day moving average, right? So which moving average to use as a trailing stop will depend on the intensity of the move and your own goals. So do you want to capture, and plus you will have to answer, do you want to capture a short term move or a long term move, right? So trend following stop is like, here you will be shifting your stop loss occasionally as the price is moving in your direction. So let's say you bought a stock and it started going up. Your original stop loss was, let's say, 5%, and the stock from your entry price has moved 10%. Now what you will be doing is that you will be shifting the stop loss with the price moving upwards, right? So again, that makes sense, because if you want to capture a longer move, right? Because again, in case of a, let's say, momentum burst kind of a setup, right? So momentum burst is simply when the price shorts up quickly in 2-3 days. So in that case, it doesn't make sense to keep your trailing your stop loss with a 10-day moving average or a 20-day moving average. Because again, why I'm saying that is, let's say a stock comes out of consolidation and it bursts 20% in a single day, right? So again, uh, for 10-day moving average to catch up the price, it will take many days, like it will take few more days, and slowly the moving average will come up. And in such cases, sometimes what happens is that the price may also start to come down. Again, that will depend on your goals, that if you're taking for if you're trading from a very short term view or from a longer point of view, right? Because again, in case of a momentum burst where the price moves 10, 20, 30% in just matter of 3-5 days, right? Some people like to book the entire profit, and some people like to book the half of the profit and trail the rest with the moving average. So here comes the trend following stop loss. So again, that will depend on your goals, if you want to capture a very short term move or if you want to capture a longer term of move. So again, if you see some examples here, so this is an example of Shada Motors. So this was a base breakout that it gave here. So again, your stop loss could be a fixed percentage here, let's say 5% from entry price, right? So now what happens is that the price is going up, right? So there are two possibilities here. There are two things that you can do. Either you can book at a certain point, let's say let's say the stock has moved 10-15% in matter of few days, or maybe 1-2 weeks. So you have decided that I want to book the profits. Or what you can do is that you can wait for the price to break any of these moving averages. In this case, as the intensity of the move is very high, what you can do is you can follow the price with a 10-day moving average. So this is the point where the stock is breaking the 10-day moving average. So this is the point where you will be selling the stock, right? So this is what we do in case of a trend following stop, right? Another example, AG's Logistics. So this was a base breakout that it gave here. And you see, let's say if you were following the stop with the 10-day moving average, this was your exit point. In case you're following the stop with the 21-day moving average, this would have been your exit point, or maybe this also would have been your exit point. Or maybe you are a slightly longer time trader or an investor. Here you can follow the stop with a 50-day moving average. Unless the price breaks the 50-day moving average, I can simply follow it, right? So again, that also depend, that totally will depend upon your goals, right? So simple, some people like to do momentum burst kind of trading, where the stock moves 30-40%, like 20-30% in just 1-2 days, and they just capture that move and get out of that stock. They don't trail it, they don't follow the trend, right? The stock can go much higher from that as well, but it doesn't matter to them, because they are just here to capture that particular move, that 10-20-30% kind of a move in 3-5 days, right? So that will again depend on if you are a trend follower kind of a trader, or a momentum burst kind of a trader, or a very short term kind of a trader, right? So again, that will depend how you follow, how you want to follow the trailing rules. Another example right here, from a recent stock that broken out. So this was a base breakout, and you see the price went up 2 days and pulled back, but again took support at an India moving average, again started heading higher, again pulled back a little, and then there was another breakout, and now again coming down. So as a trend follower trader, what you will be doing here is that you will be waiting for the price to see if the price closes below this or not, right? Or you would like to follow it with a 21-day moving average, right? So these are the multiple methods that you can follow. Or some people also like to do, as the stock moves up, try make bases, like these areas from where where the stock bounces back from the moving average. They also keep trailing their stop loss towards those areas, right? So while using the moving average as a trend following stop, you need to keep multiple things in the mind, right? So closing the trade after it has just broken the MA, or wait for the close below the moving average. So this is another really important point that you need to keep in your mind while you're trailing the stop loss using a moving average. Because again, you see this point here. Here the price broke the 21-day moving average during the day, but the closing was even above the 10-day moving average. So what do you do in this case? Do you close the position as soon as the price went below the 21-day moving average, or you are waiting for the price to close below the 21-day moving average? So that is something that you have to decide for yourself, because again, that is a very tricky question. Second is that which moving average you are going to trail with, right? So in this case, you'll see the price hasn't even broken the 10-day moving average, right? In this case, you see the price broke the 10-day very quickly, but followed the 21-day. Here you see the price hasn't broken the 10-day moving average. So that also will depend on you. How long do you want to stay with that particular stock, right? How long do you think the trend will continue? So that way you'll have to decide if you want to trail it with a using a 10-day moving average, or a 50-day moving average, or a 20-day moving average. Another point you can consider in this case is that you can look at the intensity of the price, how the price is moving up. The price is moving up like this slowly, or the price is up going like this. If the intensity of the trend is very high, simply means if the price is going up very quickly, then it's better to use the trailing method as a 10-day moving average. And in case the price is a bit slow, it's better to use a 21-day moving average. But again, that is totally subjective and will depend upon your own trailing criterias. And third one is the subjective stop that I like to use in my case. So this method that I use for myself, here I use the combination of the fixed percentage stop loss and the trend following stop loss, and most of the traders actually use this method. So I just given a name, whatever came to my mind. Okay, so in this method I have one fixed percentage of max stop loss. As I said earlier, कि I have a fixed percentage of stop loss, कि no matter what, if the stock goes down more than 6% from my entry, I will close the trade no matter what, right? So I've taken, let's say the stock is breaking out from a base, right? Stock is breaking out from a base, and my maximum stop loss point here would be 6%, right? So I'll give this stock some space कि it can move 6%. So it's not like कि I always keep the stop loss at the 6% at the entry. This is the max percentage, that this is the max amount I'm willing to lose on a particular trade, right? So again, the SL will depend on the setup, right? For example, if in case of a large base breakout, I'll go for a slightly wider stop. So in case if the stock is coming out of a very large base, I would like to give it full 6% space, right? When the stock is breaking out. In case of a tightness setup where the stock is just like this in a very narrow range, here what I like to do is I like to keep my stop loss tight and increase the position size, because again, there's too much tightness, and after the tightness comes the expansion. So I'm expecting the price to move sharply higher. So here, if I want to take the full advantage of that particular move, what I'll do is I'll keep my position size larger, and I'll keep my stop loss very tight in those particular case. And in case of trend following, whenever I am trying to follow the trend itself, overall trend, I like to follow the 21-day moving average. So DEMA is just 21-day moving average, this yellow line you see here. So this is like one of my favorite trend following method, right? Where I just simply try to keep follow the, at least, following the 21-day moving average. And in such cases, where the price sharply moves down, what I like to do is I like to book half of the position as soon as the price breaks the 21-day moving average, and I will book rest of the position if the price closes below it, right? So there are two things: if the price crosses it during the day, and if the price closes below it, right? So these are the two things that I'll keep in mind. So like in most cases, my SL would be at the breakout candles low. Let me show you some examples, right? So this is a big base breakout, and here what I did is that my stop loss is simply at the low of this breakout candle. So as I said, the stop loss would be very setup specific, right? So here I have decided a max quantity, right? Like 6%. Okay, I'm not willing to lose more than 6%, and rest will depend on the how the setup looks. My stop could be anywhere from 2% to 6%, right? and the trailing method would be the 20-20 moving average usually. But as I said earlier, if the intensity of the price is very fast, then I like to trail it with the 10-day moving average, right? So in this case, you see there was a big base breakout. Again, the entry was near the low of this particular candle, that is 3.5% from the entry. Another example, if I show, so this is one of my recent entry, and again, this is not a recommendation, right? So this is more like a tightness setup. You can clearly see the price contracting. Look at this range getting narrower and narrower, and just look at the candles forming inside bars. Again, it tried to break out, although the it squatted that day. The close wasn't really good, but again, I bought it somewhere around 508 or something that day, and my stop loss is the low of this candle, right? So if the price breaks this candle, I'll simply exit. So again, this is around 4% or so, if I remember correctly. Here again, another example of one of the successful trades is that, see, the SL was near the low of the previous candle, because again, it opened a little bit higher as compared to the previous candle. So again, the entry would have been somewhere around 430 or so, and the stop loss was around the low of the previous candle. Again, 4% from the entry price. So this is something that you have to decide for your own, right? What kind of stop loss you will be putting. But this is the most typical way of placing the stop loss, that if a stock is breaking out from a base, usually keep the stop loss at the low of that particular candle. It may not work every single time, but if the breakout is good, then most of the time this will work really well, right? So that is the most typical way to place a stop loss. Again, second, decide for yourself what is the max stop loss percentage that you would like to keep, right? And the third is decide a trailing method, right? You can either use it with a moving average 10, 21, or 50, or you can use it as the base. In case of base method, as I said, let's say if a stock is going up, I'll show you an example like this. Stock is going up, right? So this is the area it pulled back and again moved up. So what you do is you move your stop loss here. Second, it moved higher, came back and reversed from here. What you do, you keep your stop loss here. Next, again, it took a break. What you do, you keep your stop loss somewhere around here, or maybe at this candle, and that way you trail the stop loss, right? So these are the things that you need to figure out for your own trading method, right? Because these are my rules, and you can make your own rules based on these, right? So I guess uh, that is it for today's video, and I hope you guys enjoyed and you learned something new, the art of mastering the stop loss, right? So don't forget to like, subscribe, and share, and goodbye. Take